As we look on those big tech earnings that we've gotten thus far, cloud revenue was a bright spot for Amazon, though slumping demand for consumer electronics like iPhones raised red flags for investors in Apple's second quarter earnings. So far this earnings season, tech has managed to stand out in a good way, by and large. The sector saw the highest percentage of EPS consensus beats. And after largely fueling the S&P 500's positive performance in 2023, will tech continue its domination of the market in the months ahead? Let's get back to Lori here. Lori, more recently, and I'm talking about the last week or so, yes, obviously earnings have been important, but there is another big, maybe emerging headwind for tech. I'm thinking about the bond market in particular. Before, when we saw yields on the 10-year get above 4%, that's what then caused the initial sell-off that we saw in tech. Is that going to be, they're above 4%. They've come down a little bit. Is that going to continue to be the case here?
I think that seems like it's always the Achilles heel of this growth trade and this tech trade. Our rate strategy team doesn't think we're going to stay at those levels. So ultimately, if we move back down, that could give us, a little bit of life back into the tech trade. But I think the fact that when we saw bond yields move up most recently, you saw that big reaction in tech, it really did tell you equity investors have not wanted to chase this move. So if given an excuse to pull out, they're going to do it. They're going to wait for more reasonable valuations to come back in. And I think, it just goes to show you the sensitivity there, that it's not all about the long-term growth expectations. Those are important, and I think that will put a floor under the sector. So we actually still like tech longer term, but in the short term, I don't think you can get around the fact that it's a headwind for a trade that's become very, very crowded.
And much of that valuation move higher that we've seen is really tied to this AI hype phase, too, that we'd seen over the past quarter be the most mentioned or recurring theme that companies were trying to bring into their calls in some cases to really get kind of that investor sentiment propped up even further here. But now, has that started to dissipate a little bit more?
So I will tell you, I'm still sifting through what came out last week, but one of the things I have noticed and what I've read so far is there's almost some defensive AI that's coming out in the conversations. I read a number of companies early on that said, well, AI is not going to replace people. It's going to make them more productive. And you saw a number of comments like that where you could tell the companies were sort of listening to the investor pushback on all the hype and some of the regulatory concerns that were coming up and trying to address them. So I feel like the AI conversation, it's still very high. And look, I'm not a big theme person, but I do think this is a true productivity driver longer term. But I do think you've seen the tone of the conversation shift. It wasn't all hype. It was, yes, there was some hype. I had one company I read where I laughed out loud at the stretch that was being put in. I'm not going to tell you who it was, but I do think that some of the savvier tech companies, so to speak, are trying to have a more sophisticated conversation right now.
Yeah, and what you're mentioning brings up the idea that you and your team read and listen to a lot of conference calls. Yeah. I was struck by that as I've been reading your research to sort of tease out those themes and how companies are expressing those themes. How did that AI conversation shift a little bit this quarter compared with last quarter from what you've been hearing so far?
I feel like they're meatier conversations. We look at not just the prepared remarks, but also the Q&A. And so you've got the analysts kind of pushing the companies a little bit more, not just in terms of the substance of the impacts, but when are those going to play out? So I feel like it's just a much more robust conversation. And again, some companies are kind of laughable, but others, it's like a real meaty conversation. And I've described this to people as, if you think about charting tools, right? When I started out in the business, the firm I worked at had a chart room, and they put charts all up on the walls, and they had a team of like 20 people who interpreted the charts. Well, we don't have that now, right? Like we have all these like functions and these chartists. I think that's kind of the model you're working for. You're still going to have human interaction. I will, by the way, tell you that the tool we use to read transcripts does have some AI tools that help us and allow a team of 3 people to get through the whole S&P. So I feel like I'm kind of living that experience. But I think in general, it's just, if you look at the better companies, there's a real discussion going on. It's not all laughable.
And which, within tech, are those better companies? Is it companies that have kind of already gone through the cost restructuring in that kind of business-to-business landscape? Or is it some of the bounce back for some of the business-to-consumer-based tech companies that are just waiting to see when that discretionary spend will come back and forth?
I've noticed the better conversations on the software side. I can't get into individual names, but it's also been some of the bigger companies that have been involved longer. So I would say experience, I think is where you're going to get sort of a more robust application.